89% of scalpers lose money in the first 15 minutes of the market opening. I stopped doing this and my win rate on a 1-minute gold position increased by 15%. This is exactly why this swing is a trap. The biggest mistake is simple: entering trades in the first 1 to 15 minutes of the market opening. Why is this dangerous? Liquidity is volatile. Price is looking for direction. Institutions are making fake moves. Spreads are getting wider. Moving averages, EMAs, are not yet aligned. Most traders see a big candle and think, well, this is the move. But this is usually a trap. Now, how do we know we are not falling into a trap, liquidity trap? But something much more dangerous happens in the first few minutes of the market opening. This is where the smart money creates a liquidity trap. What does this mean? Market makers move prices randomly? They don't. They need liquidity to fill their big orders. And where is it? Liquidity? Above the ceilings, below the ceilings, behind clear breakouts, behind clear support and resistance levels. Stop hunt mechanism. In the first 15 minutes of the market, price makes a quick move up or down, breaks a resistance or support, retail traders enter the trade. Stop losses are behind those points. And then what? Price suddenly reverses. Stops are activated, liquidated. Smart money enters in the opposite direction. This is called stop hunt or liquidation. This happened yesterday in EURUSD, and I didn't enter, which makes you see fewer stops. Why do most traders get caught? Most scalpers. Enter on the initial breakout. Follow the first strong candle. Don't wait for confirmation. Don't check the market structure or EMA. As a result, instead of being traders, they become market liquidity. This is where EMA 9, 21, and 50 become important. These are not just entry tools, they are filters to avoid traps. EMA 50 equals general market direction, EMA 21 equals market structure, EMA 9 equals entry time. If these are not in line, then don't trade. What is smart money looking for? Liquidity. Stop retail traders entering at imbalance, and EM. As help you understand where the market is in this story, the role of EMA in smart money behavior, EMA 50 equals trend bias. If the price is above EMA 50, then bullish market. If it is below, then bearish market. Smart money usually moves in the direction of this main trend. EMA 9 is exactly where the fast moves happen. EMA 21 acts like a roadmap. Let me show you a practical example as you can see. Now let me tell you a real buying scenario so that everything fits perfectly. Suppose the market has just opened and the price has made a quick move up. Many traders get excited right here and think the main move has started and quickly enter the buying. But what they don't see is that this move is usually designed by smart money. The price makes a short ceiling in the first few minutes. Right above that ceiling, a lot of stop orders are accumulated from traders. That means there is liquidity there. Now the market makes a faster move up, breaks the ceiling. Everyone thinks a breakout has happened, and retail traders enter the buying. But that's exactly where the trap starts. A few seconds later, the price returns to the previous range. Stops that are above the ceiling are triggered, and liquidity is gathered. This is where most traders lose. Now let's look at this with EMAs. When this move happens, the price usually moves away from the EMA 9 very quickly. This means emotional and unstable movement. The EMA 21 has not yet confirmed, meaning the structure has not yet formed, and the EMA 50 is not showing any change in the overall trend. What does this mean? This means this buying move is not real, just a liquidity hunt. Now, where exactly does smart money come in? When the stops are gathered and the price is back in the range, that's when the real move begins. Nears the EMA 9 and 21, makes a clean retest, and this time comes back up with real volume. Here the situation is different. Because EMA 9 is following the price, EMA 21 is confirming the direction, and EMA 50 is also supporting the overall market trend. Now, if a higher low is made again and the price starts to move up, this is no longer the first trap. This is the real market movement. And this is where smart money enters the buying, not before. Exactly what the Wyckoff method says is that you can find the traps when trading and trade like banks or whales. With this example, you can have the best trades. Even with 1 to 8, you can make a profit. But as always, it requires risk management. Let me tell you an advanced risk that will make you both a good profit and a smaller loss. Now, let me tell you something very clearly. Fixed risk, not emotional. Most traders make a big mistake. When they are sure, they increase the volume. When they are in doubt, they reduce the volume. But professionals do the opposite. They always have a fixed risk. For example, 1% or 0.5% of the total capital in each trade. No more, no less, because you cannot control the market. You can only control the loss. Rule 2. Before you enter, determine your exit. No trade should be opened without these two things. Stop loss. Exit scenario. If you don't know where you went wrong, you shouldn't have entered at all. In the smart money model, stop should be behind the liquidity structure, not a random number. Rule 3, professional trailing. Stop. Now we come to the most important part. When a trade enters profit, most traders make two mistakes. Either they exit too soon or they turn profit into loss. What is the professional way? Trailing stop based on market structure, not a fixed number. This worked better for me. By following only this section, I was able to increase my win rate to about 8%, sometimes 10%, but sometimes the risk becomes free touch. This is not harmful at all. It helps you trust the plan and see the best setup for entry and enter when you don't have a bridge. Tell me in the comments. I will give you a PDF file that is your best personal plan based on your feelings. There is a very professional trailing stop method, but this makes it much more specialized. Professional trailing method, smart money style. When the price moves in your direction or behind the last lower high to sell, more than this equals emotional entry. Summary of this section: risk management means you accept that you are not always right, but you do something to survive even when you are wrong. Link to the full video. If you put EMA plus liquidity trap plus risk management together, this is not a simple strategy anymore. This is a professional trading system. I posted a video about forex liquidity above, if you want to watch it above. If you came this far with me, it means you are not just looking for a simple signal. You are trying to really understand the market. Remember, scalping is not a game of speed, it is a game of survival. If you don't want to miss the next videos where we go into more detail about real setups and professional strategies, be sure to subscribe to the channel and turn on notifications. Because from here on out, the game gets more serious.